Welcome back. We are now in segment 6.12, and in this segment we'll be discussing about assets. So in the segments till now, in the previous 11 segments, in this chapter 6, we have discussed about the liabilities. Please recall, in chapter 5 we have completed a discussion of all items appearing under P&L account. In chapter 6 we have started a discussion on balance sheet items. So we started with the liabilities item and finished all the items that appear under the liabilities. Here we have seen various items that appear under the owner's fund, term liabilities and current liabilities. We broadly classified the liabilities under these three major heads, and we discussed various items that can appear in a typical balance sheet under the liabilities column. So we'll continue our discussion, and now we'll proceed to assets, right? So in this segment we'll be discussing about the items that can appear under the asset side of a balance sheet, right? So just like we classified the items and the liabilities into three major categories, like owner's funds, term liabilities and current liabilities. In asset side also we have some broad classifications, right? So here we have four classifications. One, current assets, then we have fixed assets, non-current assets and intangible assets, right? These are the four major classifications which will encounter under the asset side. So the first category is the current assets. Current assets are assets that can be converted into cash within one operating cycle. That is the correct definition, but for our purpose we'll be taking within 1 year. Usually it is the practice in banking industry to take it within 1 year, right? But actually, strictly speaking, current assets are those assets which can be converted into cash within one operating cycle. We didn't come to the concept of operating cycle, which we'll be discussing another chapter of working capital. We'll discuss it when we actually get there. For the moment, just assume that, for simplicity, let us assume that any item that will be converted into cash within 1 year can be classified as a current assets. So what do you mean by converted into cash? So we already discussed that in an earlier segment. We discussed that in business, cash is a supreme form of asset. This is something which every company wants to have, right? This is the preferred form of asset. This is the preferred asset. Asset can be of various kinds, but ultimately you want it in the form of cash. The problem is cash generation is not instantaneous, right? What is the problem here? The issue here is cash generation is not instantaneous, right? So a company can be in some particular activity. Say for example, the company is into manufacturing. So it is into manufacturing, it will obtain some raw material, it will do some processing, it will have finally some finished goods. This will be selling to the customer. Of course, it will be giving some credit period. So as soon as it delivers the product to the customer, it won't get cash. It will be a credit sale. Maybe after say 30 days, it's going to get cash. So there is a process involved here from the point of getting raw material purchase till the cash is realized. There is a lot of process involved. So as and when you purchase raw material, this generation of cash, is not instantaneous. There are a lot of process involved. So if you see here, the initial cash you have in the business, you are employing it into some purpose. So initially you have procured raw material. So your cash is now converted into raw material, right? For example, you had 1 lakh rupee. You have 1 lakh rupee. The company has now purchased raw material with this 1 lakh, right? So what's happening here is the cash has changed form. This is something you have to understand very clearly. The cash has changed form. Earlier it is in the form of rupees, hard cash. It is in your vault, right? You can see the cash. It is in your bank balance. You can see it physically in the form of cash, right? But now it is converted into the form of raw material. This raw material is not equal to cash. Raw material is different and cash is different, right? Raw material is a product, like steel, right? Like cement, like paddy. It is a raw material. You do some processing to it and obtain some finished good. Then you sell the product, you get cash again. But till that time, this raw material is in the form of a product. So cash has changed form to raw material. Then that raw material will be going into the production process. And here it will be something called work in progress. When processing is going on into this raw material, some other consumables are added, some process are going on. So that cash which you originally had is now in the shape of work in progress. Then this again changes shape. When the final product is completed, the cash will be in the form of finished good and will be lying in the godown till somebody purchases. But once the person purchases it, when the finished goods move to the buyer's premises, even then you are not getting instant cash because you are selling on credit basis. So that cash is being converted into form of debtors. So you see here the cash is changing in the form. Like a chameleon, right? It is changing form from one form to another. Initially it was in the form of cash, but then you purchased raw material with it. So cash was converted into raw material. Then it was converted to work in progress, then finished goods, then debtors. And finally you are going to realize cash. Now the customer actually pays after the credit period, you're going to get back the cash. Of course, cash plus some profit. You initially had some 1 lakh cash and ultimately you're going to get some, say 1.5 lakhs. Because there are other expenses also like consumables, power, labor, a lot of some. So put together, ultimately you got some cash of 1.5 lakhs. So cash is changing form, right? Cash is not in the form of cash. So when you see a balance sheet of any company, right? When you see the balance sheet, we discussed already all items under liabilities. When you see the assets, the number of assets the company has. What did we discuss? How did we define asset earlier? In the earlier chapter, we defined asset as anything that can be converted into cash, right? This is something which you define. So we had a definition earlier when we said liabilities are all sources of funds and assets are the uses of funds. When we obtain the sources, when we obtain funds from the sources, what did we do with that money? That is the uses of funds. So asset is anything that can be converted into cash. So we said land is an asset because if you sell land, you're going to get cash. Similarly, building is a asset. Machinery is an asset, right? Your stock of inventory is also an asset. Finished good. If you sell finished good, you're going to get cash. Even raw material is a asset, even though you're not going to sell raw material in the pure form, but if you happen to sell it, you can definitely get cash. So cash is in various form here. You have purchased these assets. Please see that you have purchased all these assets using cash. So cash is now in the form of various forms. It's in the form of land. It is not in the form of real cash. Actually, there is one more item here called cash and bank balance. But then cash and bank balance is only the real cash. These are all pseudo cash. Also cash, but cash in some other form. Cash in the form of land, because you purchase land by paying cash. You purchase building, you constructed building using cash, right? You paid the construction workers using cash. You purchase this machinery using cash. You purchase raw material, finished good. You manufactured that good, right? Using cash. So cash is in various forms. Our purpose is ultimately to get the cash, right? So we get back to our definition earlier. We had a couple of definitions. We extended our definition. If you remember, under liabilities we extended a definition. One we said, of course, liability is a source of fund. Then we also extended by saying liability is something like when we avail the service, but payment not yet made. So we extended the definition of a liability. We discussed the example, say for salaries payable. So you had to pay salaries, but you have to pay the salaries by 31st March, but you didn't pay, right? So as on this date, salary is due. You had to pay by that date, but you didn't pay. So it is a liability. So liability, we extended the definition saying not only is a source of fund like capital, like term loan from bank, right? Like unsecured loans. These are sources of funds, but also liability is something where payment is pending. Payment is pending, right? Any item where payment is pending, right? Payment, you have availed service. You have availed the service, but didn't yet make the payment. So that is a liability. Similarly, we are now going to extend the definition of asset also. So earlier we said asset is anything that can be converted into cash, right? Anything that can be converted into cash. That is the uses to which we have put the sources into, right? You have what did you do with the sources of funds which you obtained from the liability side? That is the asset. Now you are also going to extend and saying one more thing. We are saying asset is something where you have already made the payment, right? But did not receive the service. This is the opposite effect of the liability extension which we did, right? Under liability we said if we avail the service but we didn't make the payment, it is a liability, like salaries payable. Here we are saying asset is something which you already made the payment but we still did not receive the service. For example, you can take for example insurance, right? If you see insurance premium, you usually for the next 1 year you will pay the insurance premium now itself. So say for example 31/3/2014. So what the insurance company will be asking is to pay the premium for the entire year, 31/3/2015. So from the period 1st April 2014 to 31/3/2015, this policy will be valid. So if anything happens, for example your machinery gets damaged, right, they will be reimbursing you, right? They will be reimbursing for the loss you have incurred during this period. Now see that you have to make the premium before this period. So when you renew the policy or you take a fresh policy on March 31st 14, the insurance policy is going to be valid for the next 1 year starting from April 1st 14 to March 31st 15th, right? So you have already paid the insurance here during this period, right? See this, during this period you need not pay any premium. You're not required to pay any premium because you already paid the premium. So as on this date, as on this balance sheet date of 31/3/2014, you have not availed the service because nothing happened to your machinery. You didn't avail the service, but you already made the payment. But you did not avail the service. When you're going to avail the service, if anything happens during the after this period, after this date, that is from April 1st to 31st March of 15, during this period, if anything happens, the insurance company is going to come to your rescue. So this is an advance payment. This is a payment you have made, but you didn't avail the service. So we have extended the definition of asset also. Asset is anything that can be converted into cash, or it is an item where you have already made the payment but you did not receive the service. So when you speak of current asset, right? So you have to understand here is current asset is anything that can be converted into cash within 1 year, right? This is how you are defining current asset. So take for example your raw material. Your raw material is a current asset. Why? The normal manufacturing process for most companies is around 3 months to 6 months. Usually you won't find a process more than this. Sometimes 2 months, sometimes 1 month. It is a period less than, usually it's around 3 months, 2 months, 1 month, right? So what you are saying is, so usually if you see the operating cycle of most companies will be less than 3 months. This is something you actually see in practice. Operating cycle will be 1 month or 2 months or 3 months, rarely above 6 months. So what we are saying is, if you push the raw material into the production process, it's going to get converted into finished goods, and the operation is going to be completed. You're going to realize the sales within 3 months or 6 months at the most. So what we are saying is, within 1 year, this is going to be converted back into cash. So there is a cycle which we discuss, that is the operating cycle, which we'll discuss again in a later chapter. What we are saying is, the raw material will be converted into work in progress, then into finished goods, then into debtors, and finally it's going to get back into cash, right? Again, with this cash you'll buy raw material. So this process is the conversion cycle. Now here the raw material is a current asset because you expect this process to be completed usually within 1 year. Very rarely you see the operating cycle greater than 1 year. So raw material is a current asset. Why you are saying raw material is a current asset? Raw material is a current asset because you can convert it into cash. Convert it into cash within a year. Or if you are desperate, if you are desperate for money, if you want to sell this raw material right now, you can receive cash. You go to the market and sell it. Maybe you not get the purchase price, but something you'll get, right? Because it's a distress sale, you'll get some amount, but you can realize cash. That is the point. Same for example, finished goods. This product is already ready. You can sell it straight away in the market. So this is also an item that can be converted into cash very quickly. So this is a current asset. What about debtors? Debtors is even more ready. The sale is made and already the payment is due for us, right? The amount is due, the payment, the goods are already delivered to the customer and payment is not made. So this is also current asset within the credit period. Say for example, credit period is 45 days. Within 45 days you're going to get back cash. You're going to get cash. So it is a current asset. What about deposit? You are aware of various deposits like electricity deposit or telephone deposit. So government companies, say for example the electricity department, when they give you connection, they'll ask you to deposit an amount. What is this amount? When for how much period you have to have this deposit? Till the period you have the connection. Is it for 1 year? Do you plan to disconnect for after 1 year? No. See, if you have an office, the premises, and you got a power connection, this is something which you expect for run for 10 years or 20 years. You don't have plans of closing it in the immediate future. So within 1 year, not going to get back this deposit. Earlier, all these they can be converted into cash within 1 year. But here, deposit is something is going to be stuck. It is going to be blocked. You're not going to get cash from it in the near future, definitely not within 1 year, and therefore it is not a current asset. It is a non-current asset. Please understand the distinction between current asset and non-current asset. Non-current asset is an item where the funds are blocked and you have no chance of getting them back within 1 year. At least your intention is not to get back it after 1 year. See, if you today decide to wind up the company, maybe the deposit will be refunded back to you, but that's a different matter. You can't say, if I close the business today, get back cash, get back the deposit, so it is a current asset. No, you can't say that. The intention is also important here. It is not your ability to get back. Similarly, machinery is not a current asset. Why it is not a current asset? If you sell the machinery, if you go to the market and sell it, somebody will definitely buy it. Maybe you bought it for 10 lakhs. Maybe somebody, if you sell it for 5 lakhs, definitely somebody will buy it. 4 lakhs, 2 lakhs, at some price you can sell. So that doesn't mean it's a current asset. See, here the intent is important. You didn't purchase machinery to sell it. See, you didn't construct your factory building to sell it. Land you didn't purchase to sell it. You're not in the business of real estate. This is a factory land. You're here to construct the factory, procure several machinery, produce a product, and then sell the product. And through this sales, you're going to get the income. These are not meant for sale. So when your intent is not selling, that funds will be blocked, right, for a very long period of time, like land, building, machinery. So these are all, you cannot classify them as current assets. So please make the distinction between current assets and the non-current assets. So assets can be classified as one, current assets. So current assets are something that can be converted into cash within 1 year. Then you have something called non-current assets. Here, these are the items where funds are blocked. Here we also make a distinction between two other classes of assets, that is fixed assets, and then you have something called the intangible assets. So what are these? So fixed, see, all these three are non-current. That's exactly to speak. This is the current assets, and rest of all are not current in nature. But we give them special names like non-current, fixed assets, intangible. As fixed assets, you'll get what you get in fixed assets. You get land, you get building, you get machinery, you have furniture, you have these items. So these you separately have a item or fixed assets, but they're also not current in nature. This is not something you're going to sell them and not going to realize cash. So these are fixed assets. They will be used in the production process for a very long period of time. Then you have these non-current assets. What do you use non-current assets? Say for example deposits, right, or investments, right? We are going to discuss these items individually, but these items are non-current assets. This is just a brief overview. We're going to discuss each and every individual asset category as we go along. This is just a brief introduction. Then we have something called tangible assets, like preliminary expenses not written off. I have accumulated losses. So you're going to discuss various items. The point is, first of all, make a distinction between what is current and what is not current. This is not non-current, right? This is not current. NOT. So there's something called current assets, and the rest of all are not current assets. So what is current asset? Something that when you convert into cash. If you want cash, you will get it within today or 1 or 2 days. At very short notice, you can get cash. That is a current asset. And that is the intention, right? And you say a current asset is not current, it cannot be converted into cash very quickly, or you have no intention of selling that asset and recovering cash. So let us start with the discussion on current assets, right? So in current assets, we can have various items like cash balance, cash and bank balance, investments. These are other than long term. Usually investments we classify as non-current assets, but then there are some investments which we can classify as current assets, as we are going to see. Debtors, inventory, supplies to raw material, advance to supply to raw material is a current asset. Advance payment of tax, prepaid expenses, and advances recoverable. These are the items we are going to discuss one by one. The first is cash and bank balance. See, cash, we already told you that cash is a supreme form of asset. This is the number one current asset. It's a supreme form of asset. So definitely when you see an item called cash and bank balance, obviously you're going to say it is a current asset because it's the most liquid asset, right? It is cash. It is straight away cash, or it is near cash. It is in the bank and you can withdraw it at any moment, right? It is equivalent to cash. This is a current asset, right? Then the question is, is a position of more cash desirable or a position of less cash? This you have to understand that it varies from business to business. A business like supermarket, like something like Spencer's, a supermarket where there will be continuous cash flow because they deal in cash usually, and some of it on credit cards. But if they deal with a lot of cash, so actually they're going to have a lot of cash. Because the business actually is such a way that they operate on a lot of cash. But say for example someone like an equipment manufacturer who deals in manufacturing, fabrication of some heavy vessels, right? And these are companies who are not going to deal in cash that much, right? When they order for raw material, it's going to be in a lot of tons. This is a fabrication of heavy vessels. Maybe they require steel. Steel is a raw material. They require some tons, hundreds and thousands of tons. This is not something which they pay cash. And similarly, when they sell this product, the product will be in crores. They're not going to take cash. So usually they won't have a business model. This business model is not operating on a lot of cash. So it varies from business to business. So we cannot say what is a correct position, whether better cash is more cash is better or less cash. But then one way we can do is we can compare, right? We can compare across similar units in the industry. But then again, in the chapter of ratio analysis, will be calculating some ratios to analyze the cash position, whether it is desirable or not. But you have to understand straight away that more cash is not desirable, in the sense that idle cash will not earn you any return. If you're a company and in your cash box you have some 10 crores of cash, it is nonsense, you see, because there's a difference between 1 lakh in your pocket and 1 lakh in a fixed deposit. There's a lot of difference. 1 lakh in your pocket is not going to earn you anything. It is idle cash, right? It's not going to do anything, whereas that 1 lakh in fixed deposit is going to earn you interest. So at the same time, I'm not saying let us maintain zero cash, because you also need cash. You need cash to pay salaries. Cash is what you're going to pay raw material supplier. So cash is also important. So what is that ideal cash? What is that balance? How you going to balance that? Whether more cash or less cash is something which you need to take care of from business to business. So of course, one thing we can do is we can compare the various companies in the similar industry and see if the cash balance maintained is in line with the major competitors. Then there is one more point which you need to be very careful. Whenever you come across an item called cash in a balance sheet, there is one item as a banker, there is one more aspect which you need to be very careful. Take for example, you are given a balance sheet. A company is applying for some credit limits. In the balance sheet, say for example, this company is having an OCC limit of say 3 crores. Now it has applied for enhancement. This wants to be enhanced to 5 crores. And then the company is submitted some CMA data. So there if you see the CMA data, this 31/3/2014 is actual. This is the latest available balance sheet. So here the item OCC, if you see the OCC item, it's already say the outstanding is some 2.97 crores. Remember that the existing limit is, because the outstanding is 2.97 crores. Now the company has submitted some projections for next 2 years. For 15 and 16, the company has submitted projections. So here the various items the company has projected some turnover. Say for example, here it is we're speaking here some 20 crores turnover is there. Maybe the company has projected 25 crores, 30 crores. This is turnover. But let us see this OCC. OCC, they know enhancement. So they're projecting it at 5 crores. This is 5 crores. So there'll be various items here, and so for each and every item they'll be giving the actual figures for last 2 years, that is 12, 13 and 14, 3 years and 2 projections. So here there are the various items. So all liabilities items, assets item there, they're going to give you. We're not going to list all items, but let us say the cash balance. Let us assume that the cash balance is another item, and here the actual cash balance, maybe they had some 25 lakhs on hand. And then when it comes to the projections, they are projecting something like say 2 crores. Now these are sort of scenarios which you need to be very careful whenever you get a proposal, especially working capital proposal, right? Especially working capital proposal, when the company is saying, when the company is projecting very high cash balance, what is high? Again, this is a subjective statement, but then vis-a-vis the limit applied. Here the company is applying 5 crores. Vis-a-vis the limit that the company is applying, 5 crores against 5 crores, 2 crores is very high. It's almost 40%, right? It is 40%. So then you have to question these projections. See, the point here is think from the company point of view. Think you're the proprietor. You are the proprietor of this company. That even 2015 they are giving these positions. But really, is this position going to ever arise? As a proprietor, are you going to allow this position? Think of yourself as a proprietor. So what you're saying is, in your bank, in your current account, company has a cash balance of 2 crores. We're speaking as on 31/3/2015. We are seeing whether this position can be ever arise. As a proprietor, are you going to allow this? So let us assume we are right now in 31/3/2015. As a proprietor, you saw that your company has some cash balance of 2 crores in the bank. Then this OCC outstanding, we are saying it is going to be 5 crores. So now you know that you have to pay interest on OCC, say some 12%. Current account is not going to fetch you any interest. So are you going to allow this as a proprietor? On one hand, you are paying 12% interest on a facility, 5 crores outstanding, and on the other hand, you're having idle cash. This cash is earning nothing. This is 2 crores idle cash. So if you are a proprietor, what you will do? You will straight away transfer 2 crores from current account to the OCC and bring down its outstanding to 3 crores. See, why you would pay 12% interest on 5 crores when you already have 2 crores idle funds? See, this 2 crores is not going to get you any interest. This is idle cash. So what you will do as an owner, you will straight away transfer this 2 crores to the OCC and bring down the liability from 5 crores to 3 crores. So the point here is, in actual business scenario, whenever companies have these sort of projections, this is something which is not going to happen in actual practice. So actually what happens is, you have to understand why this actually happens. When companies prepare CMA data, or when the accountants or the finance people or the consultants prepare projected financials, what happens is, if they get very high profit, so in the P&L, finally they got the very high profit. Maybe they'll project a high profit, present a very healthy picture of the company. So these profit, if you see the liabilities and assets, this profit will ultimately go to reserves and surplus, liability side. So this item will be very high. So the balancing figure here, it should go somewhere, right? So this high profit should go somewhere to tally the balance sheet. So they have options to fit this high amount various ways. Either they can increase the stock inventory, they can invest the debtors, they can say fixed assets, where any asset item they can increase if they want to adjust this figure. Cash, any item. So we don't discuss working capital right now. That will be discussed in a later chapter. But the point is, bankers will question if you have if you project a very high level of inventory. Say for example, you project inventory of 6 months. Again, we didn't discuss what this 6 months is. This is something called holding level. We'll discuss it when we actually get to the chapter of working capital assessment. But for the moment, please understand that bankers are going to question if you increase this figure, inventory, data, as you like. They're going to question, because they'll say, why do you need enhancement? Why do you need that much holding level? Please justify. You are not satisfied. We're not going to enhance the limit. So as a company, as a finance accountant of the company, you cannot push this amount abnormally high. So there is a reasonable ceiling to this. So you can't fit this inventory. You can't fudge much around with the data. Fixed assets anyway, you cannot change, because if you increase fixed assets, they'll be asking what are the sources. You're not applied for term loan, how are you going to? So there are a lot of issues here. So ultimately, usually what they do is they dump it under cash and bank balance. Right? This is what usually happens. Companies will be projecting a higher profit, project a healthy picture of the company, and the reserves and surplus on the liability side will be increasing. Correspondingly, they increase the cash balance. This is what is actually going to happen. So then they'll project this sort of a CMA data. What they do in the CMA data? This is 31/3/2013 actual. Actual figure, if you see cash balance, it will be very reasonable. But when it comes to projections, 14, 15, 16, they'll have a very high cash balance. Vis-a-vis the OCC limit applied here, OCC limit is 5 crores. Then they're saying 2 crores. Then if you ask a question, you ask a query to the company. This is a very high cash holding level. Please justify. What they will say? This company, we are a company that are earning very high profits. We are having very high profits. That's why we are having a comfortable cash position. But that is not acceptable. Not at all. Because as we just discussed, if the company has really that much cash, high cash, it's going to bring down OCC. You're not going to require 5 crores. If you really have 2 crores cash balance, you're going to require only 3 crores. So please understand that whenever you get a proposal, when you see an item in the balance sheet, on the balance sheet, you have liabilities and assets, right? In assets, we are going to see various items. One is cash. So see this quantum. You please check this whether this is a high amount or not. So whenever you are given a CMA projections, I'm speaking of projections. See, actual cash balance in a balance sheet submitted to you under the assets, there will be a cash and bank balance. The actual cash balance is something which is, say, will be low. It's very rarely you find a very high cash balance, and if it is high, it is for a purpose. Usually it is to meet some immediate payments. So that can be accepted, right? In a actual balance sheet. When you give an actual balance sheet, that is okay. But in the projections, in the CMA data projections, when the company is applying for enhancement of working capital especially, right? In the projections for the next coming 2 years, say 2015, 2016, the next 2 years, there when you see a very high cash balance, you always have to question the company. And please don't accept a high cash balance if it's very high compared to the projected, the enhanced limit. Say for example, this is OCCs, they're applying for 10 crores and cash balance they're projecting some 2 to 3 crores. This is not at all acceptable, right? So please keep this point in mind. Then one more thing you have to understand. So when you say this cash balance is very high, sir, we are not going to accept it. Then what they'll do? They'll immediately submit revised projections. This is again something which you have to be very careful. See, whenever you ask a query, immediately when the company submits revised projections, that means the projections are bogus. The company is not believing in the projections. See, whatever you want, if you ask a query, they immediately changing the projections and submitting the revised projections. You say 20 crores is a very high turnover, immediately they're going to submit a new set of projections saying we're now 15 crores. So if a company is changing projections so rapidly, right, to any query which they're going to change the financial, is something which to be very careful of. Projections are something which should be sacrosanct. You see, the company should be believing in these projections as something achievable, right? So when a company changes the projections as per its requirement, as per the bank's queries, it is something which to be careful. Of course, as a matter of practice, there will be some practical issues. Definitely, revised projections are going to be called for. It's not that you're going to accept the projections straight away from the company. Revised projections are usually the norm in the banking industry. That's going to happen. But the point is, when a company changes projections As and when you ask a query, whatever you want, they're going to modify that as per the bank's requirement. This is something to be carefully watch out for. You have to watch out for, right? So these are the things we already discussed. So when a company applies for working capital limit, you need to be very careful about the cash flow projected for future years. We are not speaking of actual cash. We are the projected cash. You need to be very careful, right? So this is an example which you already discussed. The OCC limit, the company is applying for 10 crores, whereas it's projecting cash balance of 2 crores or 5 crores. This is very abnormal. This should not be accepted. And to your query, the company will definitely justify saying we are generating good profits, so we don't have any plans of expansion, so we are just keeping high cash balance. That is a very faulty argument, right? That is not a correct argument. You have to immediately, because the point is, if the company is really going to have that cash, that idle cash is not going to, in the current account, it's going to have that much cash, is not going to have a high OCC outstanding and pay interest on that, right? That is the point. Okay. So then one more item under current assets which you can encounter is investments. Usually investments are long term in nature, but then there are some investments which can classify under current assets. Take for example, when we said an asset is current asset, it's something that will be quickly converted into cash. So any investment that can be immediately converted into cash, and your intention is basically to so anything that can be converted into cash quickly, that can be a current asset. Take for example fixed deposit with bank, or government securities, treasury security, quoted investments, that is investments that are listed on stock exchanges. Say for example you have some shares of Infosys, so you have shares of some listed companies, so these are all quoted investments. You can convert them into cash immediately. These are liquid. What do I mean by saying liquid? You can be converted into cash very quickly. They have a ready market and you can convert into cash quickly, therefore they are current assets. One more point, when you deal with this fixed deposits with bank, you have to be careful here. So when a company, we didn't discuss non-fund limits, right? So this we are going to discuss in chapter 9, right? When you come to non-fund limits, there we are going to discuss LC and BG. So what banks usually stipulate is they stipulate some cash margin, right? This we'll discuss in detail later. Please understand that when in case of non-fund limits, banks stipulate cash margin. So when the company is submitting projections, right? When the company has applied for some non-fund limits and has submitted CMA data projections for the next 2 years, 14, 15, say for example, under the fixed deposit, this amount has to be reflected. Say for example, the company has applied for a LC limit of 1 crore, and the cash margin bank is usually 15%, 10 to 15%. So this 15 lakhs has to be reflected in the CMA data, right? So you have to check this. Whenever you have a application for non-fund limits, you have to always ensure that the fixed deposit, the margin, right, the LCBG cash margin is reflected under the projected fixed deposit, right? So how you're going to classify this LCBG margin is again varies from bank to bank. This LCBG margin, cash margin, is usually a current asset, right? It is usually a current asset, but then there are banks who treat it as non-current asset. So please check with your bank guidelines exactly how your bank is treating them. Usually it is a current asset, right? Then we'll move on to the next item under current assets, that is receivables or debtors. So we are already clear with the concept of credit sales. What is credit sale? Credit sale is something where the product is delivered to the customer. You have sold the good, delivered to the customer, whereas the payment is not yet made. The payment is due, because this you do for competitive reasons. Due to competition, to increase your sales, you're offering some credit period, say 30 days or 45 days or 60 days, 90 days sometimes, based on the competition in the market. To encourage customers to buy your product, you're going to give credit period. So these are all credit sales. So whatever is the pending payment from the customers is going to be reflected under the head of debtors or receivables, also known as accounts receivable. So if you go to the balance sheet under liabilities assets, under assets you'll find an item called debtors, sometimes referred to as receivables or accounts receivable. This amount, say for example, this is 10 lakhs. What does it mean? This means at some point of time in the past we have made some sales and we have already delivered those products, but then these customers have not yet paid to us. Why they didn't pay to us? Either because the credit period has not yet expired. Say for example, we gave a period of 30 days, right? And this period is not yet completed. Maybe only 20 days is completed so far. So this is not yet due, not yet due. So therefore, this debtor is appearing, or it is already expired. Say it is now 40 days, but they didn't pay. So this is the payment period is over, but they didn't pay. So either way, this can appear under data. So pending payment is usually reflected under the receivables. Now you have to very clearly understand that when you look at the data figure on a balance sheet, you cannot know the age-wise breakup. Say for example, this is a sales history for a company. So in the month of February and March, the company has made these 4 transactions. These are 4 sales made in the last 2 months, February and March. So in each transaction, the company has given various credit periods. In the first case, it has given a credit period of 60 days. Next case 40, 30, 45. So if you calculate when the payment will be due, this is February 10th plus 2 months, right? So this will be April 10th. Similarly for others, you can calculate, right? Then as on this balance sheet date of 31/3/2012, if you calculate the age of debtors, right? As on this date, if you calculate the debtors, since the sale was made on February 10th, right? So the age of debtor is 50 days. In February, there are 20 more days, and in March, 30 days. So that 50 days, age of debtors. Then the age of debtors you can calculate like this. So if you see in the balance sheet, you will get a, what you will see, you will see the amount, just the amounts, debtors, some 10 lakhs. So the total sales of all this, whatever it is, it will be directly reflected. But this breakup you won't be getting. So you cannot know the quality of debtors, how old these debtors are. Say for example, our normal credit period is 30 days. We usually sell for 30 days. Then this 50 days is an outstanding debtors for more than 20 days. This buyer is not paying us. There is not a prompt payment. Say for example, if you're giving only 7 days credit, the policy of the company is going to give only credit for 1 week. Then all these are long outstanding. So you cannot know the quality, right, of the debtors. The age of debtors is something which you cannot find in the balance sheet. So in the balance sheet, what you will see, you'll only find the single item called debtors. So and so amount, 25 lakhs. That's it. So this breakup is something which you're not going to find. But if you need it, sometimes you need it. There are instances where you need it. For example, you want to do the age-wise analysis of debtors. Why you need it? Say for example, you suspect that one single borrower is contributing very highly to the sales. After the sales of the company 100 lakhs, maybe some customer is contributing 70 lakhs or 80 lakhs. This is something which you need to watch for. Why? Because a company is depending so much on one single borrower. One single borrower is contributing so much. It's a big risk to the company. Tomorrow something happens to this relations between this company, or this company fails, various reasons. If this breaks down, this company will be affected because it's depending so much heavily on this a single borrower, right? Single supplier. So sometimes you may want to dig deep into the debtors figure. Then if you want this breakup, you have to ask the company, and thus they'll be providing this age-wise analysis. So usually you will go with balance sheet figure, whatever is the in balance sheet. The breakup which you give in sometimes is debtors less than 6 months and greater than 6 months. This is sufficient for most of our purposes, right? Say for example, if the total debtors is 100 lakhs, maybe there less than debtors is 80 lakhs. Less than 6 months is 80 lakhs, balance is 20 lakhs. This is something that is usually provided. So this sort of breakup is sufficient to you on most occasions. But sometimes if you want further information, if you suspect that a single borrower, one or two customers are contributing very disproportionately to the sales of a company, then you maybe you ask the age-wise breakup, or something was pointed out in the stock and receivable audit. You have something called stock and receivable audit. Maybe the auditor there commented adversely on the quality of the debtors. Maybe you want to know further breakup. Maybe you want further detailed breakup. That is something which you can call for the company. So in the debtors, right, in the CMA debtors, you'll be also having this breakup of domestic and export receivables, right? If the company has export sales, this breakup between export receivables and domestic receivables is something which the CMA data will be something have a provision for. In CMA data, maybe you have to sometime enter this information, the breakup between domestic receivables and export receivables. This is available from the company, right? Also, this is a point which we already discussed earlier, that the provision for doubtful debts. So if the credit history is as per the history, 5% of the company debtors do not pay. This is what the company has been experiencing for the past few years. So what the company will do, it will create a provision for doubtful debts. So the treatment here is we debit the P&L account, right? So the debtors outstanding in balance sheet will also be reduced by that amount. Say for example, provision for doubtful debts, we made a provision of 10 lakhs. In the balance sheet, the debtors total is, say for example, 450 lakhs. So what the companies do, they'll deduct this provision and show only 450 lakhs. So in your CMA data, you have to take only 440 lakhs. You should not take that 450, right? Because you already made a provision of 10 lakhs. You have to take only 440 lakhs. In future, if the company happens to recover this 10 lakhs, fine. Then in the next year balance sheet will be created to the P&L account. That is something which you need not be worried. But then the point is, in the balance sheet, what they're going to show, debtors some amount, 1000 lakhs, less provision for doubtful debts, say 20 lakhs, and arrive at some figure. This is the figure you have to take in the CMA data under the head of debtors, right? Sometimes the doubtful debts are not provided for. In that case, which will take under intangible assets, but this is a point which you need not be worried too much about. You're not going to encounter them regularly, okay? The point that you need to be aware of is the classification. as far as CMA classification concerned, debtors is a current asset because we expect that the it's going to convert into cash very quickly. Usually the credit period is 30 to 90 days. So you expect within 3 months at the most the debtors will the customers will make the payment and you'll get the cash. So it is a current asset, but you should always watch out for long-standing debtors. So where are the places to find this long-standing debtors? One is the notes to accounts. Always keep producing this notes to accounts. Very important. Any long-standing debtors customers who have not paid for a long time, usually auditors make a mention of it. So make it a habit to read the notes to accounts. Right. Sometimes what happens is there will be some long-standing debtors. Say for example, there's a court case pending. So there's a debtor who has not paid, and this case is pending for 5 years in the court for 5 years. The company might sometimes include this in the debtors also. So when you say debtors is 100 lakhs. In the notes to accounts, maybe somewhere they will say, so this figure of debtors included 100 lakhs includes an amount of say 20 lakhs in respect of a particular customer who has not paid for the past 5 years. A court case is pending, right? So if they say something like this, what you have to do, you take only 80 lakhs in the debtors in the CMA data, because this customer has not paid for the past 5 years. The court case is pending. What is the guarantee he's going to pay in the next 1 year? No guarantee, right? So what you do, you as a measure of conservatism, you classify this 80 lakhs as a current asset. Current asset is something that can be converted into cash very quickly. So we are saying out of the 100 lakhs, you expect only 80 lakhs to be recovered in the next 1 year. This 20 lakhs, what do? You classify as a non-current asset, right? Is this point clear? When you are saying current asset, it is something that can be converted into cash very quickly, and usually we are saying within 1 year. So when a company has a debtors figure of say 100 lakhs, and the notes to account, it is saying somewhere that this 100 lakhs includes a 20 lakhs, and this borrower has not paid us for the past 5 years. There's a court case going on, right? In that case, what you do? This is unlikely to be recovered in the 1 year also. Past 5 years it was not recovered. So what is the guarantee that is going to be recovered in the next year? So what you do? We say out of this 100 lakh debtors, only 80 lakhs we classify as a current asset, because this is likely to be converted into cash in the next 1 year. The balance 20 lakhs please treat it as a non-current asset, right? Then there is something called usually this is a non-current asset, but then some portion of it may be some installment may be due within 1 year, in which case you classify that portion as a current asset. Anyway, this is a very rarely occurring item. So the next item that we discuss under current assets is inventory. Again, inventory is an item that can be converted into cash very quickly. Within 1 year you want to convert this inventory, whether it is raw material. If it is raw material, you're going to convert it into finished goods, sell it and get cash. So you expect this period to be completed within 1 year usually. So this is a current asset, because that inventory will be converted into cash within 1 year. That is your assumption. Therefore, you will classify inventory as current asset. Now inventory is actually a collective term, right? You use it as a collective term too. This includes various items: raw material, work in progress, finished goods, stores and space. Raw material is the raw material, right? This is something which you work on, right? Then work in progress is raw material has already started production, some process going on, but it is in the in-between stage. It is not yet converted into fully finished goods. It is in between stage. This is work in process. Finished goods is a completed product. It is completed but not sold, right? It is in the godown. Debtors is something different. There is a difference between finished goods and debtors. Finished goods is in the godown. This is not yet shipped to the customer. This is not sold. You have manufactured this but not sold. Whereas debtors is you have sold that product. The product has gone to the premises of the customer, but he didn't pay you yet. The payment is pending here, but the good is delivered already. Here it is not sold, and therefore good is still within your company premises. So understand the difference between finished goods and debtors. So here this is a collective term for raw material, work in progress, finished goods and stores and space. And this is a current asset because you are expecting that the manufacturing process will be completed, sale will be made and cash realized within 1 year. But the most important point about inventory, you have to always maintain, you have to understand as a banker, is the valuation. This is something which we discussed on the balance sheet when we discussed something called the liquidation concept. If you remember this, please go back to that concept. When we discussed this balance sheet liquidation concept, right, at the beginning of chapter 6, at the beginning of this chapter, when we discussed about balance sheet, we said we can look at balance sheet in two ways. One, as a sources of funds and uses of fund, or as a liquidation concept. So in liquidation concept, we said that if the company were to sell all its assets today and realize 800 lakhs, but if the liabilities are 800 lakhs, balance sheet is telling. So the company will receive the 800 lakhs and settle the dues. It will settle the dues of all these outside parties, whoever this 800 lakhs. But if the company receives something less than 800, say 700 lakhs, 650 lakhs, there is going to be a problem. Some of the the lenders are not going to get paid up. So that's why your asset should always represent a true position. But what happens sometimes, but for example, inventory is say 100 lakhs, and based on this you are at the 800 lakhs. But for example, you sold this and actually got only 50 lakhs, then this total will be 750 lakhs. So you won't be able to pay up the entire lender. So always one item which companies try to manipulate is the inventory due to various reasons. One is the DP calculation. We are going to see in a later chapter that just because you have OCC limit of 100 lakhs is not good enough. Bank is not going to allow you to avail OCC limit of 100 lakhs even though you have a sanction limit. There is something called DP. We're going to see DP calculation later. If the DP is only 80 lakhs, bank is going to allow only 80 lakhs even though you have a sanction limit of 100 lakhs. So your availment is always restricted to the lower of either the sanction limit or DP. So even though you have 100 lakhs, but if a DP is only 80 lakhs, we'll see what DP is later. But if DP is lower, bank is going to restrict your borrowing to 80 lakhs. They're not going to allow you to withdraw the entire 100 lakhs. So to get a higher DP, maybe company in the stock statement, the companies have to submit something called stock statement. We are going to see this also later. In the stock statement, they will provide a higher valuation. They'll say our inventory is this much higher value, and correspondingly they'll get a higher DP and draw funds. You have to watch out for all this sort of stuff. Usually, inventory is one item which companies do a lot of valuation. This is for the bankers for the purpose of DP. In the P&L account, companies what they do? Companies fudge around the inventory valuation to get a higher profit. Because if you increase the value of say finished goods, you're going to get a higher profit. Right? So this is various things that companies can do with regard to inventory calculation. Right? So you need to be very careful about these issues. Inventory valuation is a very exhaustive topic, and definitely this is not the place where you're going to discuss this. But and you need not get into all the stuff as a banker. But then you understand that the reason why there is so much discretion to the company, why company can alter this valuation so much, is because accounting policy. As per the accounting policy, you can employ various methods for valuation of inventory. You can follow what is known as FIFO average method. So if you change the valuation method, you'll get a different value of inventory. So they pay different profit. So please understand that this is an item that can be fudged around by companies. So if you are interested in really understanding the true nature, you need to get into cost accounting. Some standard book on cost accounting. You will actually understand what are these methods, how are they going to calculate, and how it affects the valuation. There is one point that you need to keep in mind in inventory. Inventory is always valued at lower of cost or realizable value. This is something which you need to be absolutely sure of as a banker. Say for example, you have a customer who is a rice mill. So he has some raw paddy in his godown. There's some paddy in the godown. Let us assume this paddy is worth. He has purchased this in the godown. There's a paddy, and he has purchased this paddy for some say 10 lakhs. Now he's drawing up the balance sheet as on 31/2014. Liabilities, assets. Under assets, you have to show this inventory. So let us assume this purchase was made somewhere in December 2013. So March 2014, when he's drawing up the balance sheet, the market value of paddy has actually increased to this 10 lakhs. If he sells in the market, he's now actually going to get 12 lakhs. So the question is what he has to show in the balance sheet. Whether he has to show the 10 lakhs or 12 lakhs. 10 lakhs is the cost at which he has purchased the paddy. But then as at the date of preparing the balance sheet, the value has gone up to 12 lakhs. So what do you have to show? 10 lakhs or 12 lakhs? 10 lakhs. Say for example, instead of 12 lakhs, the value has come down to 8 lakhs. Then what do you have to show? 8 lakhs. So please remember, inventory valuation in balance sheet, you're always going to show the lower of the cost value, whatever you purchased, right? What is the cost incurred, or the realizable value. That is, if you sell in the market, how much you're going to realize. The first example, whether you take 10 lakhs or 12 lakhs, 10 lakhs is the cost and 12 lakhs is the market value, the realizable value. So the lower, take 10 lakhs. So take 10 lakhs. In the second example, the choice is between 10 lakhs and 8 lakhs. So here the value has come down. You take the lower, 10 and 8, take 8 lakhs. So in balance sheet, the inventory value you have to take always the lower of the cost or the realizable value. This is a point which you need to keep in mind. And if you remember why we are doing this, this is as per the conservatism principle which we discussed earlier in the accounting concepts, right? So always take the lower of cost or realizable value. So be clear on the classification. Always inventory is a current asset. There might be some items that are slow moving or obsolete. This might happen. You're going to see some items that are not just moving because maybe they're outdated. Yeah? In which case you have to classify them as a non-current asset. Please always remember the current asset is something which you can convert into cash very quickly. So if there is an item, some old stock that is not moving, no, yeah, like it's not moving out of the godown, it just got stuck in the godown. That portion you treat it as a non-current asset because you are not going to get cash out of it in the near future. So besides raw material, work in progress, finished goods, and stores and spares, sometimes you can come across a term called stock in transit. Stock in transit means this material has not yet arrived in the factory premises but already shipped by the supplier. So there's a supplier in some place. You are here in the factory. So in the transit, it's in the process of transporting. It didn't receive your factory, nor it is with the supplier. Right, it's the transit. So even this you have to club it under the current asset because it's going to reach the factory premises within a short period. So that is also a current asset. Then sometimes you'll come across a term called non-consumable stores. Stores and space actually you are going to classify under current asset. But non-consumable stores and space, if you come across this item, please classify it as a non-current asset. So then we can move on to another item of the current assets, that is advance to suppliers of raw materials. This is actually something which discussed under current liabilities. There we had an item called creditors. So what is creditors? So creditors is the raw material suppliers has given us some credit period. They say you take the material but you need not pay right now. But there may be occasions where you have to actually pay advance to the raw material suppliers. Sometimes you have to do that. You are the buyer. To get the material, sometimes you have to make an advance. This happens when the product is in very high demand, right? So sometimes there will be these cases where the material supplier will give you credit, or in other cases you have to give advance. These are two opposite scenarios. So what you can do is creditors anyway you are going to show it in the current liabilities. If you have this advance to suppliers of raw material, you are going to show it in the current asset because it is a asset. How we define an asset? The second definition, it is something which have already made the payment but we didn't avail the service yet. So here we have advance, we have paid the advance but we didn't avail the service. The product is not yet given to us. So advance to supplier is a asset. It is a current asset, right? Because shortly you are going to get the material. So when you have both these figures, that is in the balance sheet, on liabilities you have some items called creditors, say 100 lakhs. Then on the asset side you have something called advance to suppliers of raw materials. Here this is some 20 lakhs. What you are going to do? Either you show these two separately like this, creditors show 100 lakhs, advance to material supply show 20 lakhs, or you can net the figures and show, instead of showing this, you can show directly 80 lakhs here. You can do the netting, you can net the figure. So the option is yours. So the next item we can discuss is the advance payment of tax. We already discussed this item on a provision for tax. Please refer the section once again. Advance payment for tax is something which we discussed earlier and it is a current asset, right? So it is not just regarding a tax. There will be other statutory dues also like advance wealth tax, various items. All these are current assets. So what actually banks do is they usually net the figures that appear on the provision for tax and the liabilities and advance tax paid. So if you see a balance sheet, under liabilities you have something, an item called, this we already discussed on the current liabilities. You have an item called provision for tax. Then on the asset side you will have an item called advance payment for tax, right? So what banks do, usually they net these figures. If this is 10 lakhs, this is 8 lakhs, say for example, they're going to show a single amount called 2 lakhs here. So this netting is something which banks usually do, though you can show it on both heads, 10 lakhs here, 8 lakhs here, there's nothing wrong in it, but usually banks net these figures, okay? Then we have something called prepaid expenses. Prepaid expenses are expenses for which the company has already paid the money but service not yet received. We already discussed the example of insurance. So in insurance, say for example, this is March 30th and the policy is lapsed. Now you have renewed the policy for 1 year. They have extended the policy. So this now the policy is valid from April 1st 2012 to 31st March 2013. Now the policy is valid for this period. If something happens during this period, the insurance company is going to reimburse you. But then here during this period you need not pay anything because you already paid the amount as on 31/3/2012. So the payment is already made, but the service is not yet available on this particular date. When the service is going to be available during this period. If anything happens during this period, you're going to get the reimbursement. So it is a prepaid expense. You already paid the expense, but the service was not yet available. So this is a current asset because the service will be rendered within 1 year. Then there are certain items called advances recoverable in cash or kind. Say for example, you have given a salary advance to your employee. An employee whose salary is 20,000. Say for example, you have given 2 months salary advance. So this 40,000 will be classified as a salary advance because it is, and it is a current asset because what is a current asset? You have made the payment but not availed service. Here, what is the service? The service is the work done by the employer. The employee, without his work, without working, he has obtained cash. You paid him but you didn't avail his services so far. So it is a asset. It is a current asset. So all these advances will be classifying under current asset, right? But then you have to understand one point, very important point. If the advance is given to directors, usually there will be loans and advances given to employees that will be classifying as current asset. But if you give a loan to a director, it should be classified as non-current asset. Why we are going to see under non-current asset? We'll be discussing this item again. But then please remember this: loans and advances given to directors will be classified as a non-current asset. Okay. So with this we come to the end of this segment. So in this segment we have discussed about current assets, right? We have mentioned that assets we can classify under four major heads. One is the current assets, fixed assets, non-current assets, and intangible assets. So now we have discussed the various items that come under current assets. So with this we will conclude the segment. In the next segment we will start the discussion on fixed assets, right? See you then.